Okay, so some clever person once said you should have as much fun making money as you do spending money. We're here to have a bit of fun at the same time, and life's not all about just serious stuff. You need to have some fun and some enjoyment and live moment to moment and make sure that you keep in perspective that all you've got is the moment that you've got right now. So it's not all about the natural gas charts, although that is what we're going to be looking at today. So I've got the chart on here, but first of all, I want to have a look at the news and see if there's anything interesting there. So let's go across and have a look at the two main sources of news. There's not an awful lot. I've scanned through them already. We'll have a look at the COT report as well, see if there's anything interesting on there. But here we've got natural gas intel. Not an awful lot. Heat waves, normal news on weather. Again, there was a bit of cooling and now the weather's sort of heating up again. So that's going to put a little bit of upward pressure on natural gas prices. And depends on how long and how hot this sort of heat cycle is. And if it really is an El Nino going forward, that's obviously going to put a prolonged pressure on the price of gas. The story of the day, natural gas futures struggle to find direction amid dubious outlook, cash prices climb. So cash prices rising a little bit. We'll have a look at the chart. We did drop off a little bit. And the comment here by Kevin Dobbs on July the 14th, which was 2 days ago on Friday, is this: natural gas futures seesawed within a narrow range of gains and losses Friday as traders weighed strong near-term cooling demand against tight LNG volumes and abundant supplies. So we've got cooling demand because of high temperatures, but we've also got abundant supplies and a lot of gas in stock. The August NYMEX gas futures contract ultimately settled at $2.539, $2.54, call it. My charts is $2.53, down 0.6 cents for the day. And the September contract, the next one to come along, which rolls over in a couple of weeks' time, shed 0.4 cents to 253.0. So there you go. So not a lot of change really overall. And if you look at the daily chart, which we'll look at shortly, it's kind of a spinning top day really. Moved up, fell back down, dropped down a bit, moved back up again. Closed at very, very similar prices to where we opened. You'll see on the daily charts a spinning top candle. It's not a reversal candle. It's not a continuation candle. It's a hesitation candle. So we'll have a look at that. Anything else here apart from heat waves? We saw the Pemex offshore fire, a wake-up call for Mexico's natural gas industry. That happened about a week ago. Natural gas forward prices post modest gains as market seeks fresh direction. That was also on Friday. Permian slowdown drives 5 rig decrease in the latest BKR tally. We saw all of that going on. Rig report we saw when we saw storage reports. But up and down, and nothing more than normal seasonal stuff, I don't think. We're not going to go into that because I don't think that's had a big effect on the price of gas. And then just one or two other things. Little article here: Europe reluctant to tap Ukrainian capacity despite rapidly falling inventories. Europe reluctant to tap Ukrainian storage capacity despite rapidly filling inventories. Some of you who follow this sort of news more intently and perhaps with a little bit more diligence and discipline might want to comment on these. So if there's anything in here that you've seen or in other reports, please leave a comment at the bottom of this video. Let's go across to natural gas world. And again, there's not really a lot. Vitol CEO says, is it Vitol or Vitol? Says difficult to predict oil balance market. Oh, that's about oil. Deloitte, Canada. Well, you know, these guys always get it right. Hedge funds and pension funds. You can take everything they say at face value, but they're saying continued natural gas price volatility. I don't think it's been that volatile, actually. We've been really stuck between about $2.20 and $2.80 for months and months and months. I don't see the pricing as being volatile. See it being range bound and fairly unpredictable within that range, but certainly not volatile. And then here's another one. US June LNG exports fall 10% on maintenance cuts, weaker demand. So a bit of drop off in demand perhaps coming through. Higher temperatures creating demand from the cooling position, but we've got a lot of gas in storage. I think that's the overall picture and really not much else to say. We've obviously got the ongoing Ukraine situation, and we don't want to go into that quagmire of military and political hot mess and talk about that. Who knows what that's going to do and how that's going to resolve. I have my own thoughts on that, but this is not the right forum for talking about that. And then here's some more on the heat wave. Texas power use breaks record for second day in heat wave. So all of that's kind of bullish for gas, for natural gas, but we're not seeing the price rallying. So that reflects a little bit about what's going on in storage. So here we go. The good old 4-hour chart on natural gas futures, the August contract on Black Bull markets. And Here's the chart, the 4-hour chart. Basically, I've covered a lot of this in the video that I did yesterday or the day before, I can't remember. So please have a look at that one. I've covered it in some detail. But basically, we've fallen back into these support levels. I want to summarize it by looking at the day chart. I'm going to switch across to that day chart. We'll have a look at the Henry Hub chart prices on the NYMEX shortly after this. But there's the day chart. This is what I was talking about. This candle on Friday was a spinning top candle. Spinning top candle is not a reversal candle. A lot of people confuse doji looking candles with wick highs and wick lows and confuse them to be reversal candles. This is not a reversal candle. This is a hesitation candle. We have closed above the support level at $2.50 roughly, $2.53. We did spike down to the 50 period moving average on the day chart and this lower channel line before back up off there quite sharply on the close on Friday. So yes, it's a hesitation candle, but it's also a little bit positive in terms of the way it's reacted. We've got the news about cooling demand and the very hot temperatures across the US and in Texas, adding impetus to the long side on natural gas. But we've also got a technical bounce off this lower channel line. Remember, we drew this in the last video that I put up. Please have a look at my last 2 videos on natural gas. I'm not going to detail all of it in this video. I'm going to give you a broader perspective on this. Some of the detail is contained in the previous videos, so please have a look at those. And don't walk away from this video and make decisions and come up with strategies unless you've watched the previous ones. Or if you just don't care what I say, that's fine too. Then don't look at any of them. I don't really mind at all. So we have bounced off this channel line. We didn't quite touch it, but we got very close to it. There's the 50-day moving average. And this pink zone denotes the sort of demand levels for natural gas. And it's also the area between the 38% Fibonacci retracement level and the 50% Fibonacci retracement level before we get into the supports below us at the 618 and the 786. Once again, I've talked about all of these in quite a lot of detail. This level here being a channel line, technically a bullish flag still, even though it's kind of lasting a little bit too long. We do want these bullish flags to be sharp and punchy, and ideally it would have ended a few days ago or a week ago or so, but still it is a bullish flag, downward sloping channel within a broader upward sloping channel and after a prolonged period of moving higher. So it is technically a bullish flag, and we have touched the bottom of that flag. And in a bullish flag, you want to be buying at the bottom of support at the bottom of the flag, or you want to be trading the breakout through the top of the flag, waiting for a move through the top of the flag, a close through the top of the flag, and then a move back down from the top side to retest it from outside and a bounce again off the top of the flag and then a move higher. So that's kind of what we're looking for. Difficult to time that on a day chart. So if you go across to the 4-hour chart, you can see the same flag drawn in there. So that's what it looks like on the 4-hour chart. What's interesting here is that once again, there's the channel bottom, the same thing you saw on the day chart. And on the 4-hour chart, we've got the 200 period moving average at the same level, more or less, as the 50-day moving average on the day chart. Now, obviously, that makes sense. If you do the mathematics between the 50-day moving average and the 200 period moving average on the 4-hour chart, they cover roughly the same sort of period of time. But here we have the 200 period moving average, and once again, there's that Fibonacci level, the pink zone that we talked about, and this flag. And what we're looking for, if you're day trading this off the 4-hour chart, look for a break through the top here, through the top of this downward sloping channel, move back down, a hold above the top there, and then a move higher. We don't really want to be trading these breakouts though on natural gas because we're so close to these resistance levels above us at around about 288, 290, and then $3. So ideally, we want to be buying into dips, not buying on breakouts higher. I think that's really important to acknowledge that, because these breakouts higher, if they do occur, are going to be too close to these big longer term resistance levels at $2.80 to 90 and then $3 just above us. I want to point out the fact that we did not manage to reach $3, and I mentioned this to someone yesterday, the fact that we didn't manage to reach $3, break up into that gap between $2.90, 88 and 90 into $3 is actually a sign of weakness. We really should have tested that $3 level once we got to 288, because there's almost no liquidity in between those two levels. There's a big gap, there's a big space between 288, 290 and $3, which would have been super easy to fill. However, we just didn't get through there, and we began to fall back down, and we're forming lower highs all the time. You can see it on the 4-hour chart, there are all the lower highs, and you can see it on the daily chart, exactly the same thing. Lower highs, lower daily highs all the time, and I'm moving down into this level. Okay, so my overall idea on this is that we've been quite well supported at the bottom of this channel. I'm long 50% of my overall position at around about $2.60. So I've got a 75% long position and a 25% short position, which means an overall net position of 50% of my desired long position size at around about $2.60. Take my long position at $2.60, my short position at $2.57. Roughly, we're at around about $2.60. So I'm 50% long at $2.60. I'm willing to add more and dips down to the support levels below us. That would be around about $2.40 and then $2.25 and then $2.15. Those sorts of levels. And I'll be watching carefully to see how these daily and 4-hourly candles react to these sorts of levels. So that's my position. That's my strategy. I'm looking for a move up to about $3. I think we could get through $2.88 or 90. Up to $3. I'm not sure if we're going to get through $3 before towards the end of the year, somewhere around about November, perhaps late October, November into December. And I think we could get a move up through $2.80 into $3. We might get there earlier, but then once we get into that winter season, towards around about November, December, I think there's a very good chance that natural gas will break up through $3 and surge higher up into $3.40, 50, 60, 75 into that region, and possibly even higher. I don't think we could take that off the table altogether. I think there's every chance we could get up through that level, and that's a very, very key level. First of all, this $3.40, 50, 60, 75 level is an area which goes back a long way on the charts. If I put a weekly chart and a monthly chart on here, you'll see exactly why. You can do that yourself on your own charts. It's also where the 200 period moving average is now falling down into quite sharply. So when this 200 period moving average, when that gets into this sort of yellow zone at this target zone that I've got set, that would be the ideal time for the price to kind of move up and meet the 200 period moving average. At some stage, we will have to get to the 200 moving average, or the 200 moving average will have to come to us. I think the former is more likely, and that we'll see the price moving up to the 200 and that they'll meet at around about 330, 340, 350, 375, and maybe even higher. You can see that the price always eventually returns to the 200 period moving average. You can go back as far as you want on your charts. At some stage, the 200 and the price will meet. Whether it's going to be lower down or higher up, I don't know. But you can see looking back over time, we always meet up with the 200 at some stage. These charts on Black Bull don't go very far back. So I'm going to switch to the NYMEX chart quickly. Just show you how this looks on the NYMEX chart, which is the same contract on NYMEX, tracking the Henry Hub price. And I've got slightly different levels in here, not the Fibonacci levels, but the support and resistance levels. You can have a look at those on your own charts and just draw them in. I've got loads and loads of videos on this, and I don't want to be repetitive and keep on going over the same things time after time. But here are the support zones. We've got very close to this yellow zone. We're into this. You could draw another pink zone above here, which you will see on the other charts. Let me just compare them for you. So there we go. There's the other chart. There's the Black Bull chart. We're into that pink zone, which I don't have drawn, but it's the sort of gap between these two levels on the NYMEX chart. And there's the 50-day moving average just coming up towards us. So allow for dips down to $2.40, 45, 30. Any of these levels, really the key levels, 250, around about 240 to 235, then 225, and then 215. I don't think we're going to get below 215. There is a chance still that we might test these lower levels. I don't think so. But there are some people that think we're going to reach down to $2 again and even perhaps drop below $2. I don't think that's going to happen. By looking at the shape of these charts overall, we're making higher highs and higher lows on the daily chart and trying to hold above these levels. If we do get back down into the $2 level and below, well, that's bargain basement time. That'll be the time to be buying more natural gas. The price has spent almost no time going back as far as you want in your charts below $2. Below $2, normally a very brief period in time, and the market normally rallies quite considerably from there, and that's definitely the time to be investing in natural gas. 255, 240, 230, we're not far above that $2 level, and the target is here where the 200 period moving average is up into this pink zone. It's pink on this chart, yellow on the other chart. So just zooming out on this NYMEX chart to give you a better perspective, you can see why this is such a crucial level here. $3.40, 50, 60, or 75. It's my target zone. Got this drawn in here on the NYMEX chart. The bonus buy zone below $2. The price spends almost no time in there going back. This chart's taking a little bit of time to get loading, but you can draw your own charts and have a look as far back as you want really on this chart. So just a sort of broad view of all of this, you can see why my target zone is up. You can see why the bonus buy zone is below $2. Not very much time spent there at all, but this target zone is really, really key. You can see it's a swing high level here at around about $3.50. Swing low there, and on various occasions it's been a really important level of supply and demand, and it kind of denotes the top of the normal range for natural gas, which I think we'll get to during the winter season or the beginning of the winter season, when the highest demand for natural gas comes in for heating your house and everyone else's house, because it gets really cold in the northern hemisphere right across America and Europe. And there you can see, once again, going back all the way to 2010, that this level is super important, super interesting, and invariably the price returns there. And so at some stage we should see just a continued move up here. I want to show you the monthly chart here very quickly to remind you of why I think what we're seeing at the moment is a bullish reversal formation, and it's not likely to continue lower below here. I know that there are a lot of people, as I said, that think this market's going to carry on going lower, but when you look at the monthly chart, you can see this feathering formation, these wick lows on the monthly charts is a very long-term chart. When you see these wicks on a monthly chart, it almost always indicates that there's a reversal taking place. We saw it down there at the bottom. We saw it over here at the bottom. We've seen it here at the top. We've seen it here at the top. And we're seeing it right now at the moment. We're seeing lots and lots of lower monthly wicks or spikes. And actually, if you compress this chart, it'll give you a better picture how that looks in the long term. So whenever you see this feathering, wicky sort of behavior, you can see more often than not it's actually a reversal. You can see why this zone below us is a bonus buy zone, and I think there's going to be pressure on commodities overall, perhaps not directly, but overall, because of continued weakness in the dollar that we're likely to see moving forward into this year. Several of my followers and subscribers have pointed out that the Henry Hub price got very little to do with the US dollar, but overall, when the dollar weakens, it affects the entire commodity market to the upside. And I think natural gas, even though it may not be a direct effect, will also be under pressure because of dollar weakness. So I see this going up into our target zone at some stage towards the end of this year, and any dips down into these wicks or feathers below us will be good opportunities to buy, starting at the price that we're at right now, and that's at around $2.50. I hope you enjoyed that. Remember to have a look at the previous videos I did, the last 2 videos on natural gas, where there's a little bit more detail. Please give the video a thumbs up and subscribe to the channel if you haven't done so already. Have a fantastic day. Market opens a few hours' time. Look out for me on Twitter. I might put a tweet up later on, depending on how the market opens. And I'll be putting out some fresh videos on natural gas and other markets as we move into next week. By the way, there's another video up on other markets on my YouTube channel. So if you're interested in stocks and currencies and metals, please have a look at that video too. Enjoy the rest of your Sunday. I'll speak to you soon.